We often receive the question, why do people take out whole life insurance policies? Or what do they do with their policies once they have them set up? And when we get that question, it is referring to individuals who are interested in whole life insurance policies or who have already taken out whole life insurance policies mainly for the cash value benefit. And the answer to that question is this. Most people we work with will take out a policy because they view the cash value as a safe area to position money, and then they can leverage it like a personal line of credit. That's typically what we'll see a lot of business owners and real estate investors do. Often we work with individuals who are very active with their money, meaning where they are earning their highest return is out in the marketplace. For example, as a business owner, where I am going to earn my highest return is by investing in my business. If I'm involved in real estate, I'm going to earn the highest return by going out into the marketplace and finding real estate opportunities. How one will use the policy in relation to that is instead of having just money in cash, which typically does not earn very much, instead I can position funds in a whole life insurance policy. And as I look at the cash value, what happens is one, it's a safe area to position money. Continues to appreciate over time. I do have a guaranteed rate that is associated with the product as well. So regardless of what happens, I have that peace of mind that my cash value will just continue to appreciate over time. Oh, and by the way, I can set it up where I fund the policy for a very short period of time. It is very common to see individuals come to the table with a lump sum of money. I've got $500,000 or $1 million in excess cash that I would like to move into a policy over the next 3 to 5 years and then never make another payment. You can do exactly that with a whole life insurance policy. That's very common to see. But it is a safe area to position money. Then I can access it like a line of credit. Let's touch on that real quick. So how this works. With a whole life insurance policy, once you have money in cash value, if I just let it sit and grow, or if I decide to borrow against the policy, I'll continue to see that appreciation on my entire cash value over time. A lot like real estate. If you own a home and it's appreciating by 5% every single year, regardless if you own that home free and clear, or if you have a mortgage outstanding against it, if the fair market value appreciates by 5%, the fair market value appreciates by 5%, your entire property value, not just the money in equity that you own. So an example here, let's pretend you've got $100,000 in cash value. We'll assume that the internal rate of return is 4%. That's the net growth rate after the company's insurance expenses and everything that comes with the life insurance policy. So 4% internal rate of return would mean that you have $100,000 in cash value, and the next year it is worth $104,000. Now, we'll assume that you take a $50,000 loan to invest in real estate, invest in your business, whatever it is you decide to do. There will be a cost to borrow, loan interest, that does go to the insurance company. The interest rate will range depending on the company. Some companies have fixed rates, some have variable rates. Those depend on the company and product. As of the day of shooting this video, January 2023, you'll see many companies have loan interest rates generally in this range, somewhere between 4 to 6%. But here's the thing. That cost to borrow goes to the insurance company. I've got $50,000 remaining in equity, money I can loan. However, that 4% internal rate of return, I see that applied still to the full $100,000, not only the remaining equity. Meaning if I were to repay the $50,000 loan and the interest, so if I repay the loan I took, what I'll see is that my cash value is fully restored to exactly what it would have been as if I never touched it in the first place. And how the insurance company does that is, one, there is a cost to borrow, so they're charging interest that helps offset the interest that they're still giving us. And then second, the death benefit's collateralized. So when I borrow against a policy, if it's $50,000, if my death benefit was $500,000 pre-loan, once I take that loan, it'll be worth $450,000, but then if I decide to repay it, I'll see my cash value restored and my death benefit. And we've got videos that provide a full breakdown on this as well. But as far as accessing it like a personal line of credit, I see that money continue to appreciate, continue to compound over time, and I can use it for opportunities knowing that I'm going to receive the constant compounding on my full bucket of money. That's often the point of attraction to a lot of individuals. Again, we see this a lot with people involved in real estate, a lot of times with business owners looking to build up a lot of cash that they can use for other opportunities. And the place they store that cash is often a whole life insurance product. Then the tax benefits. So if we do everything properly with a whole life insurance policy, we can access the cash value tax-free. I always state if we do things properly because it is possible to trigger a taxable event with a life insurance policy. I've got a video up here that provides a full breakdown as to what can trigger a taxable event with a life insurance policy. It is easy to avoid though. And then here's the big thing, awareness. What to be aware of, specifically if I fall in this category, meaning I want to use my policy for other opportunities and such. I want to access it like a personal line of credit. Where someone has buyer's remorse is when they find out after the fact that they have carried much more in expenses and costs with the product than what they've received in earnings from the insurance company. I hope that made sense. Here's a way to summarize. Cash value growth. What am I receiving in total dividends and interest, total gains from the insurance company? And then what am I paying in loan interest? And there's two ways we can look at that. We can look at the loan interest rate, or we can look at dollar amounts, which I prefer because it is much easier to follow. And what I mean when I say that is if we look at this example, if you have $100,000 in cash value and the internal rate of return is 4%, what is that in terms of growth? $4,000. If you take a $50,000 loan and the loan interest rate is 6%, how much do you pay in loan interest? $3,000. So when I look at the rate, I've got a 4% internal rate of return, but I paid 6% in loan interest. However, when I look at the dollars, I earned $4,000, but I paid $3,000. Now, of course, it was 4% on $100,000. That's why I came out ahead, and I only took a loan for $50,000. Whereas if I took a loan for the full $100,000, then what happens? Well, now all of a sudden, I've paid $6,000 in loan interest, and I'm behind. The key is this word right here, awareness. Allow me to have the awareness before I make that decision, whether it's before starting a policy or once I have a policy in place. I can make decisions by seeing the numbers illustrate for me what the cash value growth looks like and compare that directly with the loan interest. That's one area that's important to be aware of. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.